very happy to be here. We're here to talk about private credit, financial stability, and economic resilience. Just to dive right in, Apollo's definition of private credit is a $40 trillion market, majority of which is investment grade. This includes non-traded and private corporate and consumer credit found on bank balance sheets, as well as insurers, asset managers, pensions, and many others in the investor marketplace. Other market participants focus on a narrower definition of corporate lending, direct lending, broadly syndicated loans. Estimates range in that category from about $1 trillion to $3 trillion. Since the passage of Dodd-Frank and other regulations around the world, some credit provision, undeniable that some credit provision has left the banking system and has now moved to the investment marketplace, in particular in regard to long duration investment grade and direct lending. So I want to start the panel with these types of questions. In terms of the scope of the private markets, the health of private credit today, how supervisors are thinking about the migration and the growth and regulation in private markets. And Viri, why don't we start with you?
Thank you. So Viri Jackson from the UK FCA. So one's seen as a really niche area. We're seeing the growth in private markets. The AUM has tripled over the last decade. It's a really important source of funding following the financial crisis. We've seen banks step away from providing loans to corporates, and we've seen the fund managers kind of stepping in to fill that gap. Within the UK, we think our exposure to private credits via fund structures is around 1.2 trillion. And it's really important in terms of its involvement with the economic development of the UK and economic growth and supporting the real economy. So it actually accounts for 10% of the private sector employment and up to 15% of corporate debt that is deemed to be private credit. It really allows for a tailored solution. I think there's a number of risks that we'll come on to when we're discussing that are maybe more prevalent within private market and private credit compared to the public sector or private markets, public markets, I should say. But I think it's fair to say that we very much see this as a growing area, and we're keen to support that trend.
George, what are your thoughts on this?
First, let me thank the organizers for their invitation to participate in this very interesting panel. So let me start by saying that private markets in general, which includes private credit, it includes venture capital, it includes private equity. I think it's a very important market. I think there is a need basically for certain projects, certain entities of high risk to get financing, and this financing cannot come from the banking sector because of the various requirements and restrictions as it regards to lending out money to high-risk projects. And it doesn't come from the public markets as well, because we know the difficulties of the public markets and the fact that a number of entities have a difficulty in actually going through an IPO and listing in a public market. So there is a need for the private credit, and it's growing. As I understand, majority of that is in the US, but Europe is also behind. There is a 30% of the total market. It's in Europe, and there is and talking also of being part of the ESMA board, which is the European Authority for Securities and Capital Markets. There is a renewed interest in understanding more about these markets and understanding more about what it entails as it regards to risks for the investors, what it entails as it regards to risks for the system, and maybe I just very briefly point out a few of the risks that we would like to learn more about them basically as regulators, which obviously the one it's about a systemic wide risk because of interconnections between banks, asset managers, insurance and pension funds, which are obviously participants in these markets, the high complexity of the products, any liquidity mismatches that might exist, exposures in terms of leverage, conflicts of interest, complexity of the underlying products, and valuation difficulties. I think it's another one that we have to mention. So all of these things, I'm not saying that they do exist, but we have to learn more as regulators. And in order to learn more, we need to collect more data. So there is a need for collection of more data, of more disclosures, or more transparency, so that we are able to assess whether these risks are significant or not. And it's a job of the regulators to do that. And I think I'll stop here.
Thank you, George. Well said. That was kind of covered the waterfront of some of the issues that we hear quite extensively from regulators around the world. Emmanuel, what's your perspective on this question?
Well, firstly, I think I said this earlier today at a regulators summit that we hosted. We had 20 regulators discussing private credit today because we identified it 12 months ago as a topic that needed discussion amongst regulators. It's been on the agenda of regulators for some time now, with the FSB really leading the way and IOSCO coming into play. But private credit has been around for many, many decades. It's not new, but after the GFC, it's become more and more prevalent, mainly because of regulations globally, whether it's Basel or Dodd-Frank, etc. What we've seen here is a real interest in not only private credit, but private markets. As public markets are shrinking, private markets are growing, and part of those private markets is private credit. So we came out with a private credit regime just in the last couple of years. We believe that it's an area that has real opportunity, but also risks. So we've tried to manage those risks. Look, there's a number of challenges around private credit, but I think if it's done responsibly and we understand the risks, the underlying risks, whether it's the underlying assets that are involved, the credit quality, because people need to think about credit quality and the rating agencies utilize to determine that credit quality. So I think there's a lot of opportunity there, though, because the markets are constantly developing. The challenge for us as regulators, from what I'm seeing, is the appetite by retail investors to want to get into this space. Traditionally, it's been more the institutional side, the professional investor side. But we're getting more and more retail appetite and demand to enter those markets. So how do we as regulators make sure that retail investors are protected? Because ultimately, that's one of our mandates, is investor protection.
Yeah, since you mentioned retail, that is the topic du jour. I'm going to put one back to you for a second. How do you think about the risk versus the opportunity for retail? And what advice would you give market participants like Apollo in regard to its ventures to retail? And then I'm going to come to the FCA right after that because there's a huge amount of emphasis there. So.
Well, retail investors like high returns, low risk, which
don't we all
really equate very well with markets. So retail investors want access where they believe that they can have that higher return, but ultimately they need to understand, and sometimes disclosure may not be enough, but they need to understand that higher risk involved in that higher return may mean less liquidity for them.
Yeah.
So we don't want retail investors jumping into a private credit space where the assets and the instruments are illiquid in real estate. So if you have an expectation that you're going to invest in a private credit product and you're going to be able to liquidate your position very quickly, then there's a disconnect. Yep. Because those types of investments are not liquid, generally speaking. Yep. So how do you create the liquidity? If you can create some liquidity in that space, then we'll consider it. But if you can't, and you're in essence misleading investors into thinking that you can, then we have a problem.
Yeah. I gave a presentation to the ECB recently, and they first question was, what if you put 100% of a very small net worth investor's money into a illiquid private account? I'm like, that should not be happening. That is the debate that we're having as a sector, because these are the types of fears that are out there that are founded. And so, Viri, how do you think about this question, and given all the emphasis from the FCA?
I think it's a really good question. I mean, we've seen private markets outperform public markets for some time now. We do think that retail investors deserve a choice. They should be able to gain that exposure to the private markets, but through the right vehicle. So we've launched what we call the long-term asset fund within the UK. So it's an authorised open-ended fund. It has quite strict requirements in terms of its liquidity profile. So it has to have a notice period. It can't deal more frequently than monthly. And we also believe that the retail investor in this dynamic needs to take some ownership themselves. So getting to the point about diversification, so we've written into the rules that the UK retail investor should only be able to access up to 10% or invest up to 10% of their investable assets into long-term illiquid funds. We've also got really clear risk disclosures, making sure that they understand that their money could be and should be locked in for quite a period of time. But let's be clear, there's a huge range of retail investors, right through from your pension schemes that have that long-term investment horizon, right through to direct retail. So when we were developing that fund structure, we were also engaging with the institutional investors who were investing on behalf of those retail investors, and found that they didn't invest in the long-term liquid private market through pension schemes, despite having a really long investment horizon. So we've kind of developed that fund structure to kind of support that. Overall, we think it's going to really change, or there needs to be a cultural shift for retail investors to get comfortable with investing in private markets. So far, we see 3% of the markets having exposure, but we just see that growing going forward.
I agree with all of that. George, do you want to add anything? Perspectives?
Yes. So coming from the European Union, you probably are aware that there was actually last week there was a proposal coming out of the Commission regarding the SIU. It's called the Savings and Investment Union. So it's the idea of putting more of the savings of European citizens into the capital markets, basically. So there's actually 10 trillion of savings of EU citizens sitting at banks, basically. And the idea is if it's a portion of that can actually go into the capital markets. And within the SIU agenda, there is also the need to grow the private markets as well, which includes venture capital, private equity, and private credit as well. And also encourage investors to invest in long term. So, however, when it comes to investments which can be risky, I can understand if it's part of a diversified portfolio, right? So even if a retail investor wants to diversify their portfolio, investing some risky products, basically, it makes sense, basically, because it provides an element of the diversification. But we have to be careful, though, right? Because Emmanuel mentioned about the difficulties, basically, as in regards to liquidity, the difficulties as in regards to disclosures. Do they understand basically what risks are included in these types of products? So I am on the conservative side. I want the retail investors to invest more in securities and capital markets, but we need to be careful
with the guardrails. Yeah, the disclosure and the fiduciary advice that is needed for many investors, including myself, when I'm accessing things that are, I don't know. I mean, we can't all know everything. So all of these are, I think, very, very thoughtful discussions that we're having, and lots of proposals out there around the world. Coming back to, George, something you had said earlier with regard to interlinkages of the system. The word interconnections has a special meaning to all four of us on stage. Many business people that come to the table thinking about risk and so forth don't even really understand what interconnections are. So today we're having, I think, a more of a systemic risk-oriented vernacular and jargon, if you will, that I think it's commonly understood by the financial sector more broadly. So even business people are thinking now about, well, how do we think about interconnected risk and so forth? And the UK has done a lot of good work in putting out thought pieces around, well, if we have more systemic risk analysis and disclosure, then you can incorporate that back to the business managers, and then they'll think about systemic risk in that feedback loop. And I think that's kind of the world we're headed in. But with all of that said, there still is a lot of worry about the interconnections and interlinkages, both banks to non-banks, but also within the NBFI ecosystem. So George, what's your worry and observations about those types of questions?
Yes, indeed. I mean, we certainly we have to think about the interconnectedness, and obviously, we have a good example of what happened during the global financial crisis, or because of these interconnections between real estate markets and capital markets. We have seen how the crisis propagated from one market to another. So there is, and if we look at the private credit market, there are interconnections. There are interconnections between the banks on the one side, the asset managers, and then from the perspective of the investors, you have pension funds, insurance companies, which are basically investing citizens' money, for the future, for their retirement. So we need to think about, whether there is an element of systemic risk in these markets and how we go about it. And I think the FSB, the Financial Stability Board, is doing a lot of work in looking at these markets, and IOSCO as well, not only FSB and IOSCO. So some international organizations are looking at that, and there's also the conflicts of interest, right? So it could be the case that private fund firms own insurance companies, where the insurance companies are participating from the perspective of the investors, where the others are the one who are setting up the fund. So these conflicts of interest that exist, like any market, we need to deal with them basically and find ways to mitigate them, right? It's something that, and that's why I said earlier that more transparency, enhanced reporting. Actually, there was a report by the IMF last year discussing about more intense supervisory approach to funds and investors, closing the data gaps, enhancing the reporting requirements, monitoring, addressing liquidity and the contact of risk, and strengthening international cooperations are key to understanding these risks.
Okay, that's great. Emmanuel, do you want to add anything to that?
Well, I think as regulators, we're always conscious of whether a risk becomes a systemic risk and there's contagion effect. At the moment, from what we're seeing and from what we're hearing from industry bodies like AIMA, for example, is that those types of risks are not eventuating. And I think if you look at the recent collapse in the United States, where there was significant amounts of private credit involved, everyone was holding their breath to see whether there was contagion risk from First Brands. Mm-hmm. And there were a couple of others post First Brand. So it felt like what domino is going to fall next, and how fast are the dominoes? Because I still remember Bear Stearns, and it was sort of the first domino, really significant one to fall. And so as a regulator, you're always conscious of that. The interconnectedness of finance is something that you don't always have a full grasp of, because it's so global these days, and there's so many counterparties involved. And if one falls, how many others fall because of that one? Yeah. So as a regulator, we want to make sure that the systemic risk possibility, if it is arising, we need to be able to control it. And if there is an incident, we need to be able to contain it.
Yeah.
I think I saw some statistics today which were not troubling, but in the media and a lot of the data that comes out suggests there's around $3.5 trillion direct lending debt in the private credit market. And then I saw another number of 40 trillion. Mm-hmm. And that 40 trillion number was in relation to indirect lending through the private credit markets. So is there something in that could potentially lead to a contagion systemic problem? We don't absolutely know, because we don't have all the data. So that's something that, as a regulator, unnerves me a little bit, because I like to know what's going on. So these are the things that keep us up at night.
Yeah, understandable. I think we will have our day in with supervisors, and they have to all the way through the FSB just given the number of processes and inquiries that we have as a firm, I'm sure others as well, there is a huge amount of data that we have, that the market has, that is just not in this common format across the globe, across firms and so forth. So the question that we have is, what is the best use of our time, the most effective way to have risk metrics out there and to provide the comfort? And, we won't represent everyone. So we also worry about what if somebody does something really bad, and that, bad facts make really bad policy sometimes. So that's a real concern of ours. I'm going to ask one last question to each of you. If you could have one improvement in the regulatory system, or ask the market to do one thing that would help your life as a supervisor in the private credit area, what would that be?
So I would say that one of the really important things is data. So we need to know, we need to have that visibility across the market. We're working really closely in the global fora to make sure we have the taxonomy, getting the right data to do that testing. What we haven't tested is the downside. So what we're working with closely with the Bank of England and what we call the system-wide scenario test to do a system-wide stress test. So we'll effectively say, right, okay, the rating's gone down by X amount. How do all of the market participants react to that? Then we're going to say, actually, hold on, do it again, run it again. You were down, you weren't actually their preferred client, you didn't get your liquidity line, do it again. This person acted that way, that way. So I think that would be my one ask, is to see actually how everything is interconnected, and for the regulators to learn from the industry to understand where the pockets of the risk actually lie going forward.
Thank you, Governor. I think Governor Bailey will deliver some on the results next year. George?
So, I would agree that it's a provision of reliable data, right? I mean, we need data that is reliable, that we can assess and come with the analysis in order to be able to guide the market in a better way.
Thank you. Manuel?
I concur with my regulatory colleagues here. I think the only other thing I would ask industry is to be open and transparent with us about the data that they do have, and allow us to be able to supervise their activities in an open, transparent way, especially when it comes to private credit, because we're learning, and I think the industry is learning as it goes as well.
Very, very, very thoughtful. All roads lead back to transparency, it seems. And as an industry participant, I can say that's a consistent answer across the planet. So thank all of our panelists here. Very, very much appreciated.